Today is January 1st, 2026, and this lecture is going to be referring to From Vision to Execution, Simplifying Your Process. We're not trying to look for a kitchen sink approach. We're looking for something that has one or two, maybe three moving parts, and at most one market. I want you to think about how many times you as a speculator, you as a trader, you as a developing student of the markets, you're effectively trying to cast a vision over the future of these individual candlesticks, where they're going to go, where they came from, why they did what they did, and why and what time they're going to do what you're hoping will yield in terms of profit. You don't have control of the outcome. You don't know if there's going to be a sharp reversal. You don't know if the price is going to stagnate. And those are uncertainties. But for the ones that's been here for a long time and have found their groove, if you will, these charts tend to have a rhythm, has a pattern that you can tap into. And it's kind of like a knack. And I just chalk it up as experience because you get a feel for what it's trying to do. Now imagine not knowing where the market's trying to go to and how hard it would be to get in sync or in rhythm with price action. It'd be next to impossible, which is the reason why I teach the first primary function of learning how to read price action is to know where it's likely to go to. Where is it drawing to? Once you have a understanding of what it might be reaching for, then all these scenarios will start flooding your mind. Now, as a new trader, a new student, someone that sees all these things that I've made available to you, and you think, wow, I'm going to reach into the toolbox. I'm going to use everything today. Well, truth be told, my veteran students that have been pulling millions out of the market, they have adopted a mindset that they're not trying to figure out what the next 2 or 3 price runs are going to be. They're just looking at price right now, and they want to know what is it likely to do at the very moment. If there's nothing to do, it frees their mind up, and there's no worry, there's no concern, there's no fear of missing out. It's just simply, there's nothing for me to do right now, so I'm going to disengage and relax. Now, experience will dictate whether or not there's an opportunity. If there's an opportunity, then they can cast forth a vision. What you think the market's trying to do, how it will get there is the vision. Now, you may or may not realize it, but that's what every trader does. And I find it amusing when they say, your job as a trader is not to try to predict the market. What do you think you're doing? Otherwise, if you're not doing that, you're gambling. I want you to think about how casting a vision, what you think price is going to do from the moment you're looking at, which is market price. Where is it going? That's the draw on liquidity. Now, the experience factor separates those without it from those that have it at this juncture in the conversation. It will be frustrating for some of you that are brand new. It will feel like there's something being held back or it's a waste of your time. As soon as you start feeling that way, if you're brand new or if you're relatively new to my stuff, turn the video off, make a note of it in your journal that you'll come back to it with 3 months experience, and then come back in 3 months and watch this. If it doesn't feel like it's resonating with you then, come back in 6 months. I promise you, inside of 6 months, if you're doing everything I've taught on this channel, it will make much more sense to you then. But it's normal for you not to feel like it makes sense when you're first looking at it, because your assumptions are you watched a video, so therefore you must know. And that's not how this works. Let's consider the NASDAQ here. If you're looking at a price like this and you're new, a neophyte's perspective on this is, wow, that's a big drop. If I could only have seen that coming. Or others may have seen, wow, this is a pretty nice run up. I wish I could have went long there and got out before it reversed. When I was younger, I was thinking, I wish I could get in there and take every single position available and add, going long here, adding here, adding here, adding here, adding here, adding here, adding here, and then eventually getting stopped out and treat this as a mega trade. And then I went into speculating with larger amounts of money, larger risk, and I started thinking to myself, it's better for me to pick my shots. Because losing money is never fun. But when you're losing more times than you are winning, even if you are profitable as a new trader, it feels counterintuitive. It feels like not doing the right thing despite making money. And the idea that enters your mind is that you somehow are just getting lucky and eventually you're going to go into a tailspin, go on tilt, and blow the account. And as a 20-year-old, I did that a lot. And as a new trader, you're going to do that a lot too, until you wrestle yourself and start bringing your focus back to knowing where the price is likely to go next. And if that's not clear, you do nothing. And it's very liberating when you can accept the fact that there's going to be times when you're not going to know. That's the reason why I stopped trading around the holidays, because it gets very thin. The markets tend to be a little unruly, like spoiled brats. They'll run farther than you want them to, when you don't expect them to, and it feels like guesswork sometimes. Not all the time, but sometimes. And I demand the market to be Swiss precision, or I'm not engaging. You can learn how to do this as well. You'll be able to pick up on the rhythm, and you'll know when you should and shouldn't. The main thing is you have to first start by understanding where the market's likely to draw to first. This is Tuesday, December 23rd, 2025. 1 minute candlestick at 9:54 a.m. Now, why am I picking that one? Well, what you're looking at is 9:30 in the morning. They just ran it straight from there. Created a short-term high, rallied above it, false break above that, and turtle souped it right back down into the initial run. That shift right there, below the swing low in here, that displacement is significant. Go back over your NASDAQ chart and you'll see that this short-term run here stands out on your chart. So when I'm looking at price action where price has been made jagged, like it does here, I don't need it to take out that low. I just need it to show me these types of fair value gaps. So when they stand out in price action where price has had a turtle soup, a major displacement, or it just leaps out at the chart, zooming out, not zooming in tighter. By zooming out, your eye will jump right to these types of swing highs and swing lows. And when these runs are occurring, there's lots of manipulation in that. And you're going to be best served by going in and looking for these types of imbalances when they first form. Notice there's no fair value gap here until that, after it took that high. So this PD array is first presented fair value gap after turtle soup. Now this can be done on the buy side. This is a sell side. What we're looking for are standouts for fair value gap. I want you to think about what I just said about here. When you have a turtle soup sell-off, buy side taken, and it starts to sell off, you don't need this to be a market reversal. You just need it to show these types of characteristics. The first fair value gap that forms after that, keep that on your chart. Project that forward. Think about the up-to-data ranges. What's the lowest one? 20 days. Keep it on your chart for 20 days. That's why this is still valuable to me. Now, by projecting that forward, in the future, I'm already ahead of the curve. I already know this is going to be a viable level in the future. Now I just simply have to wait for time to agree and meet with that price. What does that look like? That's the high of that run. And I want you to start collecting them on your charts. And this is why having one market and being a specialist is important, because when you ask me, what do I have written down on my little notepad? It's things like this. But you're looking for the first presented fair value gap after a turtle soup sell-off or sell-side liquidity raid and runs higher. Again, you can collect these in a workspace on TradingView, or you can be old school like me. I just simply write it down. I just like to know why I'm using it, where it came from. I have my hands on it. So I prefer the high touch over high tech. Now, right away, you should know the opposite of that. It was a nice little rally all the way up in here. And overnight, here's your lows. So cast forth a vision. If it's running quickly up to that level and it proves to you it doesn't want to stay there, it starts to sell off. And then we're entering the time of day when we're looking for the opening range, 9:30 in the morning Eastern time to 10 o'clock. We're looking for that first presented fair value gap. That's that right there. Now, right away, you can see it's using it here and here. And where do you think it's drawing to? Before this even formed, before 9:30 even happened, while it's dropping down, in your mind, you're going to cast forth a vision. This is what I do. I'm looking at the market and I'm casting forth a vision. I'm waiting for a price run that creates a long, protracted down close candle. I'm waiting for that to form. I'm anticipating that to form because I know all of this reaction from this run here is likely to see us go all the way back down to take overnight lows. That's the draw. Now, the easiest way for you to have this on your chart or a routine is overnight lows. Just simply mark off midnight Eastern time to 7 o'clock in the morning. Whatever the lowest low there is, if it's relative equal lows, that's a loaded deal. That's where liquidity is. It's going to want to seek that if it's bearish. Not all the time, not that very day, but that's how I classify it. I'm looking for that lowest low overnight. In this case, we can see it being here. So that's a relative equal low. So you can see that that's obviously a standout. That's your sell side liquidity. We have the displacement here. So that's the first presented fair value gap after 9:30. And the market uses it here and here. And then we start getting into this back and forth type price action. This is classic of the holiday season. Again, another reason why I'm not a fan of trading around this time. I'd rather spend the time with my family. In here, we're going to take a look at this. We're going to zoom in and deal a little bit more with this. But I want you to think about that level right there being these lows. That's the draw. You would be casting forth a vision on how price would traverse from this first presented fair value gap down to that low. Half that run was real quick and sudden. And now it's a lot of give and take back and forth, reaching down into that sell side liquidity pool overnight. So we're going to focus in on that little area right there, and we're zooming in. Sell side imbalance, buy side inefficiency. The market creates the fair value gap when this candle closes. It trades up into it here, and we're anticipating price reaching lower. The market drops down, comes right back up, trades to the low of the fair value gap. That's the first presented fair value gap. We do not abandon the idea it's reaching for overnight lows. You cast that vision forward on the chart. You're expecting it's going to deliver. Until you're proven wrong and it's obvious, you keep that vision in mind, how it's reaching towards that relative equal low overnight. Every single candlestick has its place. It has its role in the plot, but not every single candlestick is a supporting actor, and it's not a leading man or a leading woman in the plot. I'm going to show you a lot of things here tonight, and it's going to look different in the future when you start thinking this way. When you're watching price action, it's going to help you. So the market creates this run up and then starts to slowly work lower, then gyrates sideways, moves a little bit lower, gyrates sideways, and it starts looking like a very frustrating type of profile. It's simply how price is being held in consolidation. When I see price doing this, I'm going to look for leading men or leading women candlesticks in the plot. The plot is this booger is going down to take those overnight lows out. Now, every one of these candlesticks in here is just like an extra in the cast. They're not even getting paid to be there. They're just happy to be a part of it. But what I'm looking for is I'm looking for the candlesticks that have the time in the plot to start pulling forth their best acting. We're going to bring in time now, 950 to 1010 macro. The market creates this return back into the first presented fair value gap. We anticipate this acting as a premium array. It should repel price or keep it from going in the upper half here. It just comes up, just breezes to the low of it, and then says, no, I'm not interested. No thanks. And then what does it create here? What's that? That's a SIBI. So now that is a leading man or a leading woman candlestick. It's going to be impactful. So now we want a supporting candle to come up and show how great of a candlestick this is by it coming up to half of its range. See that? So here we have the consequent encroachment of this SIBI, and then we start to see the price diving lower again. But now look closely. We're zoomed in. We have a little bit more data on the price action, and we have two relative equal lows. What makes them relative equal? The one to the right is slightly higher than the one to the left. So this is a strong candidate for a raid on that sell side algorithmically. That's how your eye is supposed to identify it, okay? It's less likely to see that immediate run. Like for instance, say we were looking at this low and that low. This is not a relative equal low. It's not a high probability. It can eventually trade through it, but not without at least retracing back for an inefficiency above the low. In other words, something going back to the left, either an inefficiency or a short-term high. That's why I'm teaching you and have taught you for years to look for the low to have the slightly higher low to the right. If it looks like this, chances are it's going to have a deeper retracement. It wants an inefficiency premium, or it wants a buy-side liquidity pool. Price runs up into these highs and fails to even get back to this old fair value gap. So it's just consolidating. Now there's a paradigm shift that takes place. When you're seeing price action doing these types of things, everything is available in these open, high, low, and close candlesticks. Everything's there. But what you're waiting for is the time for them to perform. But you have to know the plot. The plot is it's running for sell side, and the sell side is determined by overnight lows. So those lows are like that big magnet, and you're casting forth a vision that you're looking for this plot to pan out with Oscar-winning performances by very specific candlesticks at very specific times in the storytelling. During the macro, trades up to the low of the fair value gap. That's first presented fair value gap. Price trades up to consequent encroachment during the same macro. It trades lower, no fair value gap in here except for this little tiny piece right there, which is like nothing. It's like an extra in the cast. Why is this not so important? Because we haven't even broken this low. So that right there is not important to me. If this would have broken down below that, then that would have been much more salient to the plot. But because it hasn't even taken that low out, that fair value gap is just a common gap. So we had the run on minor sell side liquidity there, and then we retrace back up into the range. What's the range? See that price action right there? From the premium array it reacted to the new sell side low that was taken right here, that created that low and then started retracing. That is how you're defining your range. Let me say it again. The PD array that it sold off from, that turning point, it's the first presented fair value gap that formed after 9:30. And it's in the direction that the plot is. Sell side is going to be the target. It's going to be the draw. So we want to see this used like it does it here, sell off. And because it can't even get into the upper portion or even trade back to the consequent encroachment of that first presenter fair value gap, it's exceedingly weak. So all this in here is making it harder for someone that doesn't understand that. So the range is this right there. Now, think for a moment. When I'm looking at this range here, it's defined simply by time and my PD arrays. There's no overlap here with volume profile. There's no overlap with anything else but what I'm showing you here. Look at the midpoint. See that right there? There's a lot of price action being offered in that same range. That equilibrium price point has to have an inefficiency. Inside that range, we can see, there you go, that's a SIBI. If I take that SIBI and extend it through, look at the magic that happens. Ain't that amazing? So by having this, we can anticipate how far that shallow run below that minor sell side is going to trade right back up. And the bodies are saying, yeah, the story is still the same. All this was a plot twist. And it's causing people that don't know what they're doing to think that it's made a short-term low and it's going to rally up. But it's only going to go up to where I say it's going to go with this fair value gap. That's the equilibrium inside of this range during time distortion. That's a lot. But the veteran students knows exactly what that implies. But now you're learning how to use it. We enter another time period where price reaches up into that old SIBI. And because I'm not trading supply and demand, I'm cutting through candles. I'm going back to that one. Why did I choose that one? Because it's in the middle of the equilibrium of that range, high and low, defined by liquidity and my PD arrays. See how that is? Now I can see right away, for someone that's brand new, this is just too much and it's complicated. And how could you possibly know? Because you haven't watched price action. When you back test, the ideal scenario is for you to go back through price action because you have the benefit of hindsight. You can look at how price moved from one level to the next, but you want to go through every single individual candlestick and make a storyline of why it did this and why it didn't do that. And you're going to see these recurring phenomenon that take place in price action. They will repeat in the future. These types of things repeat over and over and over again. They may be slightly different. They may have a little bit of a character twist over here and there, but generally they're doing the same thing. They're running for inefficiency. They're running for stops. That's it. Or they're waiting during time distortion. That's what you're seeing right here. New minor sell side liquidity. After reaching up into that, it sells off. Now, the bodies come up to the high of that fair value gap there, and then we leave it and then look at the bodies. They stay right at the lower quadrant of it. It's not highlighted, but you can do this on your own chart. The wick goes almost to the top, but the bodies stay in the lower half. That's the signature that you know it's getting ready to start falling. These are characteristics that repeat over and over and over again that you will learn by listening, taking notes, and then looking for these things in your old data and then collecting them. There's no shortcut. You have to backtest. The minor sell side is taken here. And I want you to take a look how price resumed in again here, but moved over so you can see the ending run. This dive down in here, this last little piece of the run that takes us down into that overnight low. We had this small little gap after leaving this one. It comes up, trades into it. The bodies don't even come to the high of it. The wicks respect it. We drop down, consequent encroachment on that wick, and then we start to move lower. And we're going sideways, sideways, sideways until we get to a macro time. At 10:50 to 11:10, it's going to displace. Where's it going to displace? First run is here, so you cast forth a vision. Time for the market to run lower. What's the nearby sell side? There. Where's it been drawing to, and where's the original vision that you cast forth over the chart? Overnight lows. It dives down. You have long stretched out black limousines running down to the 654 club below that low. When you see price action through this lens of creating a narrative, a plot, why it should do this, why it shouldn't do that, what candles are standing out? They're leading men or leading women candlesticks in the storyline. They're going to have a major role. And the candles that use them later on, this over here, these are supporting actors. The supporting actor is saying, yes, this actress is falling apart. And we're going to show that she's falling apart because we can't overtake the high of that. And we're stopping right in the middle with the bodies. And then we have more supporting actors over here with these candlesticks, only go up to half of it. So the plot's not changed. Everything's the same, just the date's different. That's all it is. This here is the same thing that is. We're in a range, consolidation. This old SIBI is a reclaimed fair value gap. It's being utilized here, but notice it only starts to displace lower when we enter the macro time. We run lower to take that low, and then we take that original overnight sell side out there. But wait, there's more. If we look at the overall run now, all this price action in here, this is how I use narrative. And then I talk about how the candles shouldn't and should do. What I'm outlining here is that skill set, how you adopt it, how do you learn how to do it like I do it. You have to create these little storylines in old price runs. And by understanding the primary factors of what makes my smart money concepts what they are, that logic behind them, one piece of the puzzle at a time. This is something that would kill most people trading, but I'm explaining it to you in a manner where you can still see the value in learning how to do this on your own as backtesting, which will transfer into future prognostication because you'll learn to cast forth a vision on what is permissible for price. If it really is going to go down there and take that sell side out, what is reasonable for price to do this or not that? What limitations would you place on it if you controlled price? This is all part of narrative. Narrative trumps market structure because what you don't realize is there's a thing called time distortion. Time distortion can screw up current market structure. And then these moves will jump out of nowhere. Like, where'd that come from? Right. And you'll see them complaining on social media. I don't know what's going on. You can't trade this mess. My students are in here doing it. And you can do it too. It's simply knowing what you're doing, knowing what not to do, when not to expect something, when to expect it. And it's all a derivative of time first. Time, then price. It's always drawing to one of two things, sell side or buy side liquidity, or it's running for a premium inefficiency above price or an inefficiency below price. That's the only things that can happen, folks, unless a geopolitical event comes out and the market takes off, and then there it is. Let's look at the afternoon. Now, I teach don't trade between 11:30 in the morning to 1:30 in the afternoon if you're brand new because you're going to get chopped up. That lunch macro is sneaky. And if you don't know what you're doing, it can hurt you. So the way you avoid it is simply don't do anything. Wait till 1:30 in the afternoon, come back to your charts, and watch how price sets up the PM session. Market rallies up, approaches what? First percent to fair value gap again. Right in here, you can see we have minor sell side. It's high probability, relative equal lows. Why? Because the lows to the right of that one are slightly higher. We have an old low of the day formed at AM session. So you have AM session lows during regular trading hours. So that's regular trading hours, AM session low, sell side. You don't have to be all this wordy. But for teaching purposes, I'm differentiating it so that way you know, because I want you to know it the right way. I want you to learn it properly. The market sells off from here. Where should it sell off to? Sell side here. And then you want to see speed. If it can get below these lows, if it can speed up and start having elongated candlesticks to the downside, then you know it's likely to do what? Reach for that sell side there. So that's the reason why I teach partials. These lows here are perfect candidates to take a partial if you're shorting up here. This is an inversion fair value gap because it's the last major displacement on the upside before it hits a premium array and then it folds over. That right there is your model 2022, just on a very small time frame. And it's the first fair value gap after the rotation over. That right there. These are all things I've taught on this channel. It's not new teachings here. It's my old stuff being presented in a way where it helps you build a narrative, because that's what casting forth a vision is. Read Habakkuk chapter 2, verse 2 and 3. And it's very much applicable to what you do as a trader using any methodology. If it's a method that has value, those two verses, they're wonderful. The market drops aggressively after taking that low out and then clears the AM session regular trading hours low and just dives lower. Moving forward and offering the remainder of the day, you can see inversion fair value gap, uses the consequent encroachment there, sells off, fair value gap there, use that, sell it off, consolidation, breaks lower, and then just fizzles out into the low going into the close of the day. Now, why did this run up here like that and then sell off? What makes that happen? And if you're looking at just simply 1 minute charts or 5 minute charts or 15-minute charts or 1 hour charts, you're not going to get what you need. You have to have a proper top-down analysis, and you have to at least consider the daily chart. If you aren't at least conferring with the daily chart in your trading, you are trading blind. Eventually, the inevitable is going to come, and it's going to come collect your head, and your account will be collateral damage. How will we use that information? What are we looking for? Oh, here's the daily chart. And I just recently, in 2025, released another PD array. It's the suspension block. Now, normally, folks would look at this candlestick's low to that candlestick's high and say that's an inefficiency. Well, yes, there's an inefficiency there, yes. But the real inefficiency is framed by the volume imbalance down here and that volume imbalance there. So this candlestick's open and that candlestick's close. That's what's being shown here. So this candle's what's being highlighted. It's the ICT suspension block. It's another form of buy side imbalance, sell side inefficiency. It is not, underscore, not a quote unquote liquidity void. Okay. A liquidity void is when there's no trading at all. That's an actual gap. There's no buying and selling in there. That's a liquidity void. There's been no liquidity offered at all. That's the only void that exists in price. So there's your suspension block. Now, by having this information on your chart, let's go back down into that same chart. Wow. What you're saying, ICT, is the market went down, couldn't even get to the upper quadrant of it, and consolidated, and then it retraced right back up towards the first present fair value gap, and it's the high of that suspension block on the daily chart. That's a premium array. What do you think a premium array on a daily chart is going to do to price if it's bearish? Send it lower. Do you think it went lower off of that? Sure it did. But a lot of you probably were caught off guard because you're not looking for things on the daily chart. Cast forth a vision. Where's price at now? Is it allowed to go to this high, to this inefficiency? Is it working in the upper half of a inefficiency above price while still being bearish? Is it respecting only the lower half of that? That's indicating bearishness. It's weak. It's going to send price lower. All these factors have to be weighed in the balance while you're doing it. Just simply submit to the process. Go through it slowly. Take notes. Watch what price has done yesterday, last week, and break them down. Do this with your charts. Notice what it's done here. At 130, it creates that little run up to the top of that daily suspension block. That right there is this high of that candlestick's open. So that little segment inside that candlestick is price simply going right here, going up to go down. That's all it is. When you anticipate when price is going to likely do these types of things and gravitate towards half of this range here, that's this blue line here. Up here, upper quadrant, that's reasonable because it would be going below that low. If there's sell side below that, try to reach to the upper quadrant of that daily suspension block. It hits it, and look what it does. It hits it and slices through it. So it means what? It's likely going to reach for half of that range. That's down here. And it just fell short of it there. We have the new week opening gap presently today formed there. But that's a nice drop off. That right in here, I actually was working with my son Caleb, and I'm trying to get him to learn how to trade. So he knows that I did this trade in here, and that little tiny little piece of a move was enough to make $2,100 on paper. Because it's holiday, I'm not trying to get out here and be stupid, right? So, but it proves the point. Just getting out there and looking for something that makes sense. Is there a narrative that you can exploit behind what price is doing at the moment? If you can't build a narrative as why price is doing what you think it should do to find a price run to profit off of, if you can't make that make sense in price action, chances are you're forcing a setup, you're gambling, and you're going to go on tilt. That means you're simply bored or you're being impatient and you're not following a model. You're gambling. If there isn't a plug and play approach to what I see in price action, I've been here before. I know what it's doing. I know what it's trying to do here. I know it's going to use this type of manipulation. I know it's going to try to do this or that. That's how I can read every candle. And when I can't read every candle, I take a step back and say, I'm not interested. I use the pre-market hours, 7 o'clock to 9:30 in the morning. I'll watch during those times. And if I'm really dialed in and I'm calling every candlestick's fluctuation and I'm really in rhythm with it, I know I'm going to destroy the opening range. And I'm going to probably get the low of the day or the high of the day and just rip the market apart. But if I'm not able to do that in pre-market hours, then I'm going to wait probably till 10 o'clock. So I'll let the first 30 minutes trade. See how beneficial that is, knowing that? Now, if you're not someone that considers the marketplace before 9:30 and you're not considering what the market's done between 7 o'clock in the morning Eastern time to 9:30 open, that's a plethora of opportunities in and of itself there. But for setting the tone for what the market should and shouldn't do, how it should behave, how it should deliver after 9:30 opening bell, there's no better resource than determining what the pre-market's done. In this case, this market ran up straight up during pre-market session just to get to an old December 23rd displacement fair value gap after a turtle soup. Those things matter. The concept of first presentation is important. It's very important. And if you understand what you're looking for, there's logic behind it.